Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So there's going to be a lot to discuss on the EIA show. We had a lot of new information. So far things are very consistent with where we should be on a seasonal basis. We've had a steady increase in oil builds. We had a fairly sizable gasoline build, but a lot of that can be attested to where we think demand is going and imports at this point. And then when you look at U.S. exports, they continue to fall, which is what we've been talking about, and more specifically oil and refined products, while propane and ethane is something separate, which we've tried to separate the two between liquids exports and then refined products and oil exports, because one is going to continue to be strong, the other is going to continue to be weak. And we keep seeing these big shifts in the market where we now finally have a lot of the crude that we've been talking about starting to show up in the U.S. when we look at imports. Some of that is going to continue, and we'll talk about what is coming from Iraq and the Middle East. We've had some Nigerian crude start to show up, and a lot of this was purchased ahead of EIA and then during EIA, which again is going to keep this consistent through essentially the month of October, but really start to pick up pace in the essentially really next week is when we should start to see some of these show up. And then a huge amount of product is coming into the Gulf of, into the Atlantic Basin. And a lot of that is, again, from Asia with, and realistically, there's a 17-month high of clean products, which is gasoline, jet fuel, diesel, coming from the Asia, but a lot of it is from India into the Atlantic Basin. There was just a headline just came out. Tanker holding Saudi jet fuel diverts to New York from Europe. So you're starting to, again, once you get into the Atlantic Basin, it's then where is the best market? And so they could come in expecting to go to Europe and then get a better market in the US, and you'll start to see that pivot. So in general, we just have a lot of product coming into the US, into Europe, and it's a matter of where is the demand? Is there enough demand to offset? Or is it where we're gonna start to see some of these builds accelerate? And right now it's on the gasoline side, we think builds will accelerate, but on the distillate side is where it gets very interesting, and we're going to go through some of those dynamics as we go forward. So first, just kicking off, just showing, again, some of these pictures as to where crude inventories are. So when we look at where crude had a build of 2.35 million, that's still 45.8 million below the 5-year average. But one of the things that we've been, really kind of pointing to and highlighting is that this is typically when we build. And I know that people on Twitter and those in our comments have been saying, like, we'll get continuous draws. And it's like, well, not really. It's it's the seasonal normal. Like, none of this is abnormal. It's a bit abnormal if you look at it from the I think the overly bullish perspective, where draws will continue. We're still at a fairly low rate. We're below 2019, but again, we're tracking 2019, 2018, and 2015. The question is going to be the pace. And one of the things that we think is going to happen over the next few weeks is the pace of build is going to accelerate due to Line 3 coming online. It kicked off October 1st, so we're at the front end of kind of where this is going to be. So we will get additional Canadian imports, and then we will have that increase coming from the floating market as our exports continue to be very expensive versus the global market, which again is just going to hinder how much continues to move into the broader world. Then when you look at Europe's gasoline exports, when you look at the overall shifts, we had a little bit of a slowdown, but again, we still had high diesel flows. And that's one of the things that we're going to continue to watch, where European refined fuel shipments to the Americas have slowed down in early October, while diesel bookings on the route remain elevated. And that's where we continue to see some of this pushback in terms of where will the flows end up once they're in the Atlantic Basin. European exports to the Americas, have risen to 777,000 tons so far this month. And again, it's just a matter of when does it get shipped? When does it hit the water? which is why we will see some of this gasoline imports remain a bit elevated, but diesel and disti is going to be the question, especially when we start considering what is going to happen with gas to oil switching and is there feasibility for it. And we'll talk about that here, and then we're going to talk about it in greater detail in the economy show under the European section, where we given just where we think some of this accelerated crude burn could come from. When we look at days of supply, they continue to creep higher. When you look at just where things sit right now, we did get a decent increase of 1.5% in refinery runs. And remember, our view was that the high end could be 89%. We actually came in at 89.6%. So again, right above right through our target. And one of the things is this is kind of the last push before we start to see some of that slowdown, because remember, there was that delay in maintenance that was kicked from September into October, and it's supposed to kick off either this week or next. So we will start to see this come down. The question is going to be, do we get one more really good push, especially given where crack spreads are? And one of the things that I've had questions on is, why are crack spreads doing so well? And if you think about what we've been talking about, was that OSPs, or official selling prices, were going to get cut. And if you think about where those OSPs are, a lot of that margin gets passed straight on to the refiner, because they're going to be buying it essentially below where the benchmarks are. You also have the benefit of distillate. The distillate spread has done very well. It's had a little bit of a retracement, but still very elevated versus where it was. Even though gasoline remains an overhang, you're still seeing that bid. So you have a strong disty backdrop mixed with a cut in OSPs. So even though you've had an increase in cost of operation from the cost of hydrogen and natural gas, you're still getting some of that benefit. So again, these are going to be things to watch, which is when we look at some of the builds differently. When we look at days of supply, you can see that there's been an increase, and now we're right back up to where we were in 2016 on our way to 2017. Now, the pace is the same. When you look at just where we get this pivot, call it end of September, you start to see a pivot higher. So it's not crazy. It's usually because we get a build in oil and we get a cut in refinery run rates. So here, something very similar. It's just we're starting from an elevated level, and it's clear as to why. When you look at just we still are fairly low on the oil side, but refinery runs still remain a little bit low. They're elevated for this time of year, but just given where we sit, where the flows are going to come from, that's going to continue to adjust. And then the number of super tankers signaling China is at the highest level in 3 weeks, while vessels heading for the U.S. rebounded from their lows, with U.S.-bound ships gained by 3 to 23, which is the highest since June 18th. So again, that's where, when we look at what is coming next, that is that next wave. Some of them are much closer than others. It's going to be a very consistent push when you look at PADDIII and what those imports are going to do to the underlying our underlying market. Then when you look and take crude storage and products, you can see that we've started to see that build very much along the lines of 2018, 2015, in terms of the kind of that steady grind higher. And we just think that the pace is going to be very consistent. Gasoline's going to continue to see some builds. We should see a bit more of a pivot on the production side. So just to give you an example, the production of gasoline was down about 1.28%. where there was about a 20 basis point increase in distillate. So we're going to continue to see that movement and that acceleration as disti continues to attract some of that capacity. But in general, we're going to see a steady build in both storage and products. And here's where we had the biggest driver when you look at gasoline storage. We're coming right back up, and we're moving in the wrong direction. So this is one of the ones where, when you look at 2017, which is when you think about Harvey, some of that backdrop, we think it's going to continue to move back up and come back to the highs, just given the amount of imports that are coming in and where demand is looking, especially when you go forward, looking at some of the gas buddy data and some of the TomTom data. Now, European gasoline arrivals in the U.S. surged by 42% to an 8-week high in the 7 days through September 30th, while diesel imports gained week over week. So again, you're seeing some of that kind of finish out, because a lot of this is from September 30th. When were they recognized? When did they come back through? And that's when you get some of this was recognized last week, some this week. So we do expect a decline in gasoline imports, but still be elevated versus historics. Now on the distillate side is where we continue to see a lot of this bullishness, where you can see just how low we are versus historics, and that peach line, if you will, is really where the average is, and we're well off of that average. Now we have flatlined for the most part, and there's going to be a mixture of imports and a pivot of refining capacity targeting this specific cut. But there's a lot of room to make up. Now, we've seen it in the past where they can catch up quickly. It's just given the dynamics in the market, where diesel prices are, where diesel demand is, it's unlikely to see this big increase in storage. This will continue to be the bullish side, as we've been highlighting essentially since the beginning of the year, how diesel is going to remain the bright spot when you look at the refined product offerings. And then European imports of clean petroleum product from India are set to rise in October. 6 ships hauling about 460,000 tons of clean products between them are currently signaling European ports. Some of that, that's why we look at where some of the adjustments may be. Tankers are currently sailing toward the Suez Canal, though are not currently signaling a European port or arrival date. So again, we have some that's already come through, and then there's going to be more behind it. And as it gets closer, it may start to adjust. Not all of that might end up in Europe. Some of it might end up in the U.S., especially based on where some of these numbers sit. And when you look at it, that's the highest monthly import so far this year, was in June at 470,000. So you're getting an idea of just where, again, these shipments continue to move into. Then when you look at jet is fell back down. And remember, there's a lot of fungibility with kerosene and the disti pool, and they can be put together, they can be pulled apart. So just given where the pricing is, that's why you're seeing some of this strength in the jet side, because you have to have that competition of, again, recovering it, or just in terms of what some of the movements will be versus jet or the disti cut. Now, when we look at the curve, you can see that we continue to move into steeper and steeper backwardation, which again, if it's, and this is what we'll touch on this in the third segment, looking at the physical market versus the futures market, because this is essentially telling us that you should be selling it now. There's, and this comes to pass of what is future demand versus current demand. And if you think pent-up demand is going to be, let's call it January, then realistically you should be buying later in the cycle, not right now. But again, here's where we can see where the backwardation is at the moment. And given where this whole system has come on this big pull up in the futures market, you can see it shifted the whole curve to the right, again, increasing the profitability, pushing things well above 65, deep into 2023. Then you're above 60, well into the end of 2024, and that's when then obviously when you get towards 2026, everything kind of merges together. But it's hard to really dictate because the volume is really in the first 12 months, if you will. So that's what we like to look at, and we'll talk more about time spreads versus some December versus December, and some other metrics that we always look at comparing the futures market versus the physical market in segment 3. So then when we look at COVID, just to look at cases continue to be fairly flat. UK, Europe, US, there's really not much to write home about. There is a decent drop that has happened in Japan. Some of the pace in Malaysia, Thailand continues to come down. The pace is slowing. South Korea had a little bit of an increase for their holiday, but again, nothing has changed in general. The one thing that has changed, and we'll talk about this in segment 2, is the pace of vaccinations is accelerating in Asia, which the hope is that you'll see some of this come down, and again, you'll see more of that normalcy start to bake into the economic backdrop. Now, looking at the data in general for crude, so crude had a big build of 2.35 million, and big is relative just because it's big versus estimates, but again, 2.35 million, very consistent for this time of year. That's 45.8 million below the 5-year average. But again, that a lot of that is being done or is being recognized in PADDIII, where PADDIII is 21.4 million below the 5-year average. But they're going to see a big increase on that line 3 in terms of that Canadian crude coming down. So line 3 should be able to do about 760,000 barrels a day. And then when you look at what comes on rail, it's typically maxes out at about 186,000 barrels a day. So that's where, when we talk about what happens in PADDIII and imports, that's that lumpiness that we normally saw with what comes through rail. But now with line 3, fully coming into operation, that'll help adjust some of this capacity. And then when you look at Cushing had a build of 1.55 million. And remember, our view is that you're going to get some displacement as the imports increase into PADDIII, which is going to push more crude into Cushing. It's still 14.8 million below the 5-year average. It's below the 15-year average. So again, Cushing still has a lot of room, but that's why we've been talking about looking at the 4-week rolling average when it comes to Cushing, just given sheer size and just where things are. We've had some smaller draws, smaller builds. So now we're going to start to see a little bit of acceleration. This is high. We don't think it'll stay over 1 million, but we think that the builds will continue. Again, very much along that seasonal move. And then we had builds in a small build in PADDIII, essentially negligible of 70,000 barrels. PADDIII was a small draw of 440. PADDIII, a build of 1.38 million, with PADDII, essentially a draw of about 990,000. Then when you look at the SPR, remember there's still some of that crude coming out of the SPR coming into the market. So once you factor in what came into the market in general, you only had a build of 1.43 million, not that build of 2.35, because we did disperse some of that crude from the SPR. Remember, as we talked about with coming through, based for since EIA, trying to keep some of that that swap coming through. And then when you look at production was up another 200,000 barrels, as we were saying last week, just given what has been fixed in the Gulf of Mexico. So that's something that's going to continue to come through in general. And then that moved us to about 11.3 million. We will see that creep a bit higher over the next few weeks, but again, it's just going to get closer to that 11.5 that we've been highlighting. Now, when we look at storage levels, here you can see land storage. It's west of Suez is starting to flatline. It's going to start to curl back up. East of Suez has come back down, but we see that spiking back up. Remember, the land storage had an issue. When you look at what happened in China with the power issues, you did get some of that crude moving through, especially in Japan. That it will start to normalize. Again, nothing crazy. It'll still be right around the 5-year average. One of the things that we expect is to see a slight acceleration of builds in the west of Suez. But you can see, just based on that 5-year average, this is typically when we start to see it. So again, it's just going to be a matter of where is the pace, because we're starting from a lower point, which will keep us, but again, moving back towards that 5-year. And then when you look at offshore storage, this is where we continue to see this floating storage well above the 5-year average, which again, when you factor that in, things don't look as rosy onshore when you look offshore. And it comes down to east of Suez. As we said, 3 weeks before the typhoon came through, we expected to see a big drop in floating storage and then a big recovery. And it's just because boats had to move out of the way of the storm. Now they're back to where they are, and we will see that accelerate, just given, and the reason why east of Suez will accelerate. You have power issues that remain in the ports. You have Golden Week, which goes through the end of this week. That is also limiting the amount of activity in China. And then you just have more boats showing up as some of these crudes have been pulled into motion. And the hope is that the cut in OSPs will help accelerate some of those movements in general and start to get, again, more crude into transit, which then will create more crude in floating storage at their destinations, just given the inherent backlog. On the road fuel side, as we were saying, Europe is still elevated. It's come down a bit, but still well above normal. China's stuck around. You'll see a little bit of a spike in China just because of Golden Week, but it's still going to be below what is deemed quote unquote normal, while the Americas and rest of Asia essentially flatline at these levels. And it's just going to be a matter of when does it show up. Rest of Asia, we had some of this recovery back to normal normal being relative, that 80% of 2019 levels. And we just see that being continuous through the next few weeks, with the same with the Americas, of that kind of the flatlining here, just given where we are on a seasonal side, and then where we sit on just the pressure, if you will, on the consumer, given where gasoline prices are, where diesel prices are, and what that's going to do to the underlying, mobility and activity that we've seen so far. Now, when we look at oil inventory in PADDIII, as we were saying, we expected this just to go sideways, just because exports are going to be the huge overhang. Exports had a big drop of about 900,000 barrels a day. Again, a little too far, that'll bounce. But then the question is, are exports going to bounce before the imports show up, or will the imports show up right when the exports, and then it'll be negligible? So realistically, we just see this going sideways in PADDIII, because you're going to have export pressure, imports coming through. So we just see this going sideways. And as you look, the comps get easier. And we just see something very similar to what happened in 2016, 2019, where you kind of come to this level and you get a little bit of movements up and down, but essentially you stay fairly flat through the end of the year. And that's what we see in general. Maybe we start to get some of those increases in PADDIII as those imports accelerate and run rates come down. But if that happens, we see that crude getting worked through fairly quickly, especially given the distillate backdrop. Now, when you look at Cushing, that pink line, or fuchsia, if you will, you can see that's the 15-year average. You can see that we're butting up right against it. We expect to see those accelerate, and again, it's not crazy to see an acceleration when you look at all of these other years, whether that be 2020, whether that be 2019, or 2011. We always have builds at this point in time, and it's just going to be, the pace is going to be very measured. But we will see that slow increase as we get into the end of October. Now, when we look at runs here, where you get that nice little bump of about 1.5%, going from 88.1 to 89.6. So that's above our top end, and you can see that all of that was really driven by PADDIII. So that's something that, again, something to consider when you look at 230,000 barrels coming back. Some of that will come off. You had Marathon with an oil leak, but so far that hasn't really adjusted operations because it was at a holding tank. But we will have those maintenance periods coming through, just taking us essentially back to 87%, 86, 87%. But it will be done over the next 3 weeks, not going from 89.6 right down to 87. It's going to go from 89.6 to maybe 88.9, and then you're going to see that move through. But there could be that nice one more push that will give us some additional throughput in general. Then when you look at just imports, so we had a big increase in imports of 481,000 barrels a day, bringing us just over 7 million. You can see PADDII had an increase of 209. It was PADDII that had an increase of 643,000 barrels a day. And remember, we had a drop of 600,000 from Canada. Now we have an increase of 643. So you could see that we're still 335,000 above the 5-year average. PADDIII had a drop of 329,000, and that's something that, again, is going to reverse, and you're going to see PADDIII actually see a big increase closer to about 2 million barrels a day. It's just going to be a matter of, does it start this week or next week? And just based on what we're seeing, we'll get a bump this week, but we're not going to see the big meat of it start to come through until the next, based on how it's reported, 2 weeks from now, because the big elevated amount starts coming next week. And then PADDIII still remaining strong, down 66,000 barrels, but still, again, about 200,000 barrels above the 5-year average. That's going to be continuous. It's just going to be a matter of when does it show up, just based on how bad the backlog is. The backlog is in PADDIII. Then when we look at implied demand, one of the things that we continue to see is, instead of being these sharp moves up and down, you're seeing some sticking points. And instead of having an upside down V, you're getting kind of this flat line, and then you have this drop. And the same happened again in gasoline. So gasoline had a small increase of 28,000 barrels a day from 9.399 to 9.4. That's one where we think there will be next week that drop to about 9.1. Distillate had that bump that we were talking about of about 400,000 barrels a day. It came up 392,000. That's where we think we're going to live, between that 3.9, 4.3, well above the 5-year average. But again, it's just going to be a matter of how is it being counted? How is it being moved into the system? Jet fuel had a nice bounce of 267,000 barrels, which is above kind of the top end that we were expecting. But we've seen it before. You get the big spike and then the drop down, and that's going to continue. So one of the things that we expect is next week, all three of them will get a drop. The ones that will be bigger than it will be gasoline and jet on a percentage level, but diesel or distillate will remain elevated. Propane had an increase of 179,000 barrels a day. That's going to stay strong when we think about crop drying. We're in really the heart of the harvest. That's going to continue to be strong, while we do have an increase in obviously petchems, exports, and just local consumption in general. So that will remain elevated overall. And those European refined imports, exports into the U.S. will remain elevated, which if you look at it, we are the best place in terms of a lot of different demand functions versus the rest of the world, which again is attracting a lot of those imports, which will continue through the remainder of this month. Floating storage came to zero, and that which is again making room for what we see coming. How much of it will be put in storage? How much of it will be run straight through? It'll just be a matter of timing, given kind of where we sit in the functionality. As we were saying last week, we expected to see a drop in imports just because we did get that big spike, which we were above what we were expecting. So now we're right back to kind of where we think we're going to live, with another increase coming. It's just going to be a matter of, where is that timing? We won't get back to the 5-year average quite yet, but we'll still be well within the cloud as we go sideways with those imports coming back through from the Middle East and West Africa. Imports into PADDIII spiked well above the 5-year top. So we set a new seasonally adjusted high. This now will see this maintain a much higher level than previous. Before we were saying we were going to stay above that 5-year average. Now, as we have Line 3 firing up, we have crude by rail. We have a lot of that crude in Canada was increased in storage to prepare for this. That will keep us essentially above the seasonal top. Again, just being very strong, coming down into not only just PADDIII, but then continue on into PADDIII. When we look at refinery run rates, it's above the 29-year average, but we're right in line with Harvey. And you can see where the drop was from Ida, and now based on where it was, we're not going to get back there. It'll go flat and then start to fall. But when you look at that fall, again, very seasonal, nothing crazy to report in terms of where some of those demand functions will be. Now, in the next segment, we're going to look at what is happening with demand overall and where those demand functions sit, just because there's some timing delay, there's some good, there's some bad, and we want to look at what we're predicting and what we're projecting for as we come into kind of the heart of that shoulder season.